things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing. I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty...
The world economy is suffering from inflation, which has driven up prices for everything from groceries to gas. On top of this, the entire stock market is crashing and falling. Although there aren't many people can do to prevent inflation at the register, Berkshire Hathaway CEOs and renowned investor Warren Buffett thinks there are steps people may take to guard against its impacts and trade in a crashing market. Buffett reiterated his time-tested advice in his speech at the Berkshire Hathaway Annual Shareholders meeting in 2022, saying that one of the best ways to combat inflation is by honing your abilities and striving to be the best in your industry. He also gave tips on how to trade in a crashing market. The 91-year-old remarked that the best thing you can do is be brilliant at something. Buffett stated that people are going to give you some of what they create in exchange for what you supply, using the instances of doctors and lawyers as examples. In this video, we will be talking about how to trade in a market that is crashing now. This could be your chance of becoming a millionaire when people are actually freaking out. Make sure to watch till the end to know all the hacks and become a millionaire in such a market. Down markets are seen as opportunities to bolster their portfolios. You must consider what it means to be a long-term investment before you can consider doing that. A long-term investor purchases stock in a company to hold it for a very long time. A long-term investor typically has an investing thesis or a justification for why they want to own the stock. Even if the company's stock price declines, the long-term investor should still have confidence in that stock. A long-term investor monitors their holdings to ensure the business hasn't changed in a way that leads it to depart from that thesis. For instance, did the CEO change and the new executive significantly change how the business is run? Or perhaps a significant market event altered your perception of the company's prospects. Long-term investors know that many businesses struggle to produce quarterly results to make the greatest choices for the organization's long-term success. Using Amazon as an example, the company has been ready to endure financially challenging periods to invest in the infrastructure necessary for long-term success. Good companies are sold during bear markets, stock market crashes, and downturns. Even if the bear market continues and the stock price declines, if you have a firm you believe in and possibly already own, you can acquire shares with complete confidence that you are making the best decision for your future. Long-term investing entails years, if not decades, and when the price of a stock declines due to market or macroeconomic factors, you can acquire additional shares and implement the dollar-cost averaging strategy. In this case, you buy shares as funds permit and average the price you have paid to possess stock in the company, rather than waiting for the best price. Warren Buffett adheres to the same principles and has made well-known statements. He said, "Someone planted a tree a long time ago, and today someone is sitting in the shade." Two quotes from the Oracle of Omaha support this idea. Don't even consider buying a stock for 10 minutes if you aren't willing to hold it for 10 years. Forever is our preferred holding period. If you want to invest well during this market downturn, the most important thing to keep in mind is to not panic. Some people should not own stocks at all because they simply become too upset by price changes. If you're going to do foolish things because your stock drops, you shouldn't own stock at all. What are dumb things? Selling a stock. Yeah, because it drops. If you buy your house for $20,000 and someone comes along next time, that's when. Because the quote is 15, you choose not to sell it. Suppose you get educated on what you're buying, which is a piece of a business, and the longer you hold stocks. In that case, the less risky they become compared to the longer the maturity of a bond, the riskier it becomes. More people would likely be emotionally and psychologically prepared to own stocks. This all goes back to Ben Graham's concept of Mr. Market, which Buffett actually mentions himself. If you have a nosy neighbor who constantly peers over the fence and makes you offer on your home, one day he might offer you $800,000. The next day it might be $750,000. And then one day he just pops out feeling depressed and thinks the real estate market might crash. and he only offers you $30,000, are you going to sell him your home? Of course not. The same thing would happen in the stock market. Don't be that guy who sells a stock just because the fundamentals have changed. If the price decline is due to a factor that will permanently harm the company's ability to generate cash flow moving forward, and it no longer makes sense to hold the company, then, by all means, get rid of it. However, if you've done the research and you're confident in your analysis, then hold on to the stock. Buffett's investment strategy is founded on the idea that a margin of safety should come first. A margin of safety, put simply, is a feature of an investment that helps guard against investors losing money. There is a $2 margin of safety, for instance. If a stock trades for $10 per share, but the assets of the company are worth $12 per share, the asset's intrinsic value should keep the company's stock price from dropping too much. Always paying less than a company's intrinsic value is Buffett's objective. He claims that the results of a later decade of favorable business growth can be undone by a too high purchase price for the stock of an excellent company. Although buying low and selling high is the obvious objective of stock investing, human nature often drives us to make the opposite decision. We feel compelled to invest our money when we observe all of our friends prospering. We also tend to sell our shares as soon as a market meltdown occurs to avoid future price declines. When stock prices fall, there are possibilities to purchase at a discount, which Buffett loves. Would you panic and flee if you discovered that your favorite store's pricing had suddenly dropped by 20% while shopping there? Not. Buffett welcomes price reductions on his preferred stocks and declares, opportunities are few and far between. Put out the bucket when it starts to rain gold, not the thimble. In a recent interview, Buffett explains how he deals with the market. He says, "We never agreed to anything because we believe the economy will improve over the following year or two. And we have never declined anything because we are currently experiencing a panic even though the price was reasonable. I don't use money as a guideline for anything because, well, it's entertainment. It's like going to a variety show or anything. But I just don't know of any economist who has actually bought businesses well or done well in the stock market." Paul Samuelson might not have known he was a significant Berkshire shareholder. You know that if an apple falls from a tree, that isn't going to change over the centuries because of anything or political developments or 400 other variables that go into it. But when you get into economics, there are so many variables, and the reality is that you have to expect good times and bad times in business. They come with the territory. And if you were to buy an auto dealership, a McDonald's franchise, or anything similar where you live, you wouldn't try to time the purchase. Instead, you would try to make the right choice at the right price and make sure you had a solid business. However, you wouldn't say, "I'm going to buy it because growth this year is going to be 3 instead of 2.8, or something similar. We must reiterate that all cryptocurrencies are subject to market volatility, that every investment must be followed through on, and you should conduct thorough research before making any investments before moving further. What do you think? Remember that this is not a professional advice, but based on our own research and opinion. We have reached the end on this one. See you at the next one.